We're now ready for the conclusion of our Chapter 19 video lecture. This here just shows the average annual return on different asset classes. So notice that they're all showing a positive return, but small company stocks return 16.2%, large companies almost 12%, corporate bonds 6%, government bonds 5.9%, treasury bills 3.4%. So this is showing the average returns on these different asset classes. So you want to diversify your investment, meaning you want to have different type of investment groups. So you might have some stocks, you may have bonds, some large companies, some small companies. You want to make sure that you don't have what we call all your eggs in one basket. So it's important that you know how to properly diversify your portfolio strategy. That will decrease your risk, the chance of losing everything, because you don't want to have all your money tied up into just one company or one type of investment strategy. Okay? These are the primary investment services or consumer needs. For you and I, we need advice about savings and investing, help with our 401k plans, which is a retirement plan offered through our employer. We need help with retirement planning, tax planning, estate planning, and educational expense planning. So these are the most common needs of investors when it comes to securities. Okay. Perceptions of the market. You may have heard the term about a bull market or a bear market. When there's a bull market, that means investors believe stock prices are going to rise. When there's a bear market, investors believe stock prices are going to decline. And there's something called capital gains. Those are the difference between the purchase price of a stock and its sales price. So if you bought a stock for $100, but you sold it for $175, you had a capital gain of $75. And yes, you do have to pay taxes on your capital gains. Okay? Now, there are different strategies when it comes to investing in stocks that I encourage you all to uh, look more into. They're what we call blue chip stocks, which are typically these corporations like your AT&T, Google, Amazon, who have a strong history of showing a positive return. There are growth stocks, investment stock, penny stocks are companies where the stock prices are normally less than $1. But those stocks may not be as strong financially. When you buy a stock, you can do what we call a market order, which means you're going to buy those stocks immediately, or what we call a limit order, where you say, well, I want to buy or sell a stock if it meets a specific price. That's known as a limit order. Okay? Stock splits is when a company gives stockholders two or more shares of stock for each one they own. Let me explain that. With a stock split, if you were, let's say that you own one share of stock in a company and they did a 2-for-1 stock split, then one share now becomes two shares of stock. Now, what happens also is that the value of the stock price goes down, but you now have more shares of stock. So if you own one share of stock with a value of $100 and there's a 2-for-1 stock split, you will now own two shares of stock worth $50 each. Now, the beauty is that if the stock price goes back up, you now have additional shares of stock, which allows you to make an actual profit. Okay? So, firms cannot be forced to do a stock split. Typically, they do a stock split when they feel that the stock selling price is too high for the average investors. Here are some terms you need to understand when it comes to looking at stocks and their quotation. Typically, we'll look at one. They'll show the stock high price of the day and the low price, and they also show that same information over a 52-week period. It'll show any dividends paid, if applicable, dividends yields. It may show ratios such as the price earnings ratio, earnings per share, and the number of shares that have been traded. So let's take a look at a sample for the Microsoft company. So as of this date, it was selling at a price of $71.74 per share. That stock price had decreased 74 cents or 1% from the previous day. You see here, previously it closed at $72.47 a share. This is showing the market cap, and these numbers are how many shares can be actually issued. It is showing the 52-week range. So the stock has been as low as $55, but as high as $74. This is showing how many shares of stock have actually been traded. So understand how to read this type of information when it comes to the actual stock market. Okay? So this is the NASDAQ price wall, which you can find in Times Square in New York City. It's going to list all day. It shows some of the major company stock price, and it rotates on some type of timer system. Okay? These are some sites you can go to that shares information about companies' finances, Bloomberg's, Forbes, MS Money, The Street, Dow Jones, The Motley Fool. These are all financial news and research sites that provide you with information about securities. Okay? Now, investing in bonds, maturity. So, if you sell your bond to another investor before the maturity date, you may have to sell it at a discount. Meaning that if a bond matures in 10 years, but you're saying, I can't wait, it's year 5, I need my money now, you can sell the bond to someone else, but typically because it hasn't been carried what we call term, the full 10-year period, you have to sell that bond what we call a discount. If other investors value your bond, you maybe sell it at a premium. A premium is when a bond is sold at a price above its principal value. As interest rates go up, bond prices fall, and vice versa. Okay? So we talk about risk. The bond rating shows the risk for the bonds. So if a bond has a AAA rating, low risk. If there's a C rating, the bond has a high risk. But typically, the higher the risk, the higher the interest rate that is being issued by that particular bond issuer. Okay? Junk bonds. You ever heard of junk bonds? Well, junk bonds are bonds that have a high risk, a high default rate, meaning the bond issuer has defaulted on bond payments in the past. However, those bonds have a higher interest rate. So if you feel like taking a chance on these junk bonds, you might receive a higher return on your investment, or you may not get paid anything at all. It is a risk. Mutual funds. Mutual fund is an organization that buys stocks and bonds and then sells shares in those securities to the public. They're going to pool money of investors and buy stocks according to the fund's purpose. So with a mutual fund, what happens is that they'll take my money, your neighbor's money, etc., put it all together, and they're going to buy stocks and bonds of different companies. Okay? So it's simple to change your investment objective with mutual funds. So mutual funds give you some diversification. So the mutual fund, again, now you're not just buying stocks of one company, but they're taking again the resources, pulling those together, and they're buying stocks and bonds of a number of companies to try to reduce the risk when it comes to investment. ETF or exchange traded funds are a collection of stocks that are traded on exchanges but are traded more like individual stocks than like mutual funds. So if you get an account through Charles Schwab, you're going to be buying what we call ETFs, exchange traded funds, where pretty much you're able to buy a stock on an open stock exchange market. You can also purchase an ETF on an open stock exchange market. Okay, so this slide is just showing the different type of investments, the degree of risk, possible growth, and the expected income. So if you want to be conservative, you would buy bonds. Bonds have a low degree of risk. The income is secured, but the possible growth is going to be little. Bonds are going to pay a lower interest rate compared to common stock, which does have a higher degree of risk. The expected income is going to vary depending on the stock price, but stocks do have the potential of providing you with a strong capital gain. Okay? The Dow indicates the direction of the stock market based on the average cost of how many industrial stocks. If you said A, that is correct, 30. So the Dow Jones Industrial Average, it looks at the average cost of 30 selected stocks used to give an indication of the direction of the stock market over time. So what the Dow Jones says is based upon the performance of these 30 stocks, it predicts whether the stock market will be what we call a bull, meaning prices are going up, or if it's going to be a bear market, meaning prices are going down. Now, some feel that 30 companies is too small of a sample and suggest you follow the S&P 500. What the S&P does, they track the performance of 500 stocks, not 30, to determine the overall performance of the stock market. Okay? So this is showing so the Dow used to only look at 12 companies, but now it is 30. And so these are the 30 companies that the Dow Jones looks at to determine whether the market is performing well or if the market is not performing well. So as you can see, these are some pretty well-known what we call blue chip stocks, but these are the 30 companies that the Dow Jones looks at to determine as what we call market indicators. Okay, so of course, riding the market is a roller coaster. The market can be up or it can be down. The market did collapse between 2000 and 2002 when the tech stock bubble burst. So before that time period, people were making millions of dollars by buying stock in these tech companies, but the tech that did crash between 2000 and 2002, and then back in 2008, there was a massive exodus from the stock market. It also had an impact on the real estate market, resulting in record losses. So, yes, you can make a lot of money in the stock market, but you can also lose a lot of money in the stock market. Now, since 2019, the market has experienced a lot of growth until COVID took place in 2020, and that also had a negative impact on the stock market. Okay? So this next slide just talks about the key Dodd-Frank provisions. These are provisions used to try to clean up the stock market. So it gave the government power to seize and shutter large institutions on the verge of collapse. So you heard about the government coming in and bailing out some of those companies. It created the Consumer Financial Protection Bureau to watch over the interests of American consumers by reviewing and enforcing federal financial laws. So this provision pretty much allows the government to intervene to protect the consumers when it comes to security. Okay? That concludes our Chapter 19 video lectures. Talk to you soon.